In this video, I will be discussing topics of a time-sensitive nature, but the concepts discussed in this video are timeless. So, if you happen to scroll upon this video 1 or 2 years from now, the information contained in this video is still relevant. I hope you enjoy it. CLO funds are down double digits. Investors are panicking. Distribution cuts are hitting headlines. And while market sentiment and macro uncertainty certainly contributed to the recent market price declines, the real reason for the latest distribution cuts has been building for years. Today, we are going to discuss the recent distribution cuts in CLO closed-end funds and the recently announced 5-for-1 stock split reversal announced by OXLC. We're not going to spend a lot of time on this topic because what is going on is really not that complicated to understand. First, what happened? There isn't a whole lot of information out there to explain recent distribution cuts in the CLO space. While CLO funds are still delivering yield, the market is pricing in liquidity risk, spread compression, and macro caution. It's a classic case of fundamentals versus sentiment, and sentiment is winning for now. However, if we look under the hood of some of these CLO funds, there are fundamental challenges that need to be remedied, including the real reason why some CLO funds recently cut their distributions. Were there signs a distribution cut was coming? Absolutely. In this video, we're going to place emphasis on the closed-end fund OXLC, but the current challenges facing OXLC apply to other CLO funds as well. In March of this year, Closed-End Fund Mastery published a newsletter to its members addressing these challenges. Warning sign number 1: net investment income deficits resulting from an overly aggressive distribution policy. The first challenge Closed-End Fund Mastery wrote about were the most recently reported net investment income deficits, and I quote, "Conditions regarding distributions surrounding 2020 were considerably different than they are today, but this is a problem that needs to be addressed." End quote. And those concerns have since then become more prevalent, as we shall soon see. Now, there's nothing wrong with an overly aggressive distribution policy when we're talking about high-yield closed-end funds. As a matter of fact, a large percentage of closed-end funds currently have overly aggressive distribution policies. The most common among them are funds that pay a high percentage of return of capital, or ROC. But things tend to get a little more complicated when you combine an overly aggressive distribution policy with aggressive capital growth. Let me show you what I mean. Here is the information that was presented to closed-end fund mastery readers in March of 2025. Let's start with distributions. When I presented this data to members in March, I made point of the fact that since 2020, CLO funds have been covering distributions satisfactorily. Not poorly. Not comfortably, just satisfactorily, and that upon their most recent report at the time, OXLC net investment income to distribution showed a lag in the amount of net investment income received, similar to 2020. And it wasn't just OXLC either. Here's EIC and XFLT. Now, one report does not make a trend, so at that time, there was no real cause for alarm. As a matter of fact, if we dig a little deeper into OXLC's net investment income picture over the past few years, deficits to distribution are not a rare instance at all. From 2018 to 2021, OXLC was bobbing in and out of net investment income deficits every other period. So this is nothing new. Warning sign number 2: even bigger net investment income deficits. What was cause for alarm made itself obvious in the following report. Their most recent report, an even bigger net investment income to distribution deficit. And again, not just OXLC, but EIC and XFLT as well. From negative 15.8% to negative 31.9% for OXLC, a negative 20.5% to a negative 25.8% for EIC, and a negative 5.3% to a considerably higher negative 21.7% for XFLT. Warning sign number 3: aggressive capital growth. Again, from the article in March of 2025, quote, "What's so concerning about this is that over the last several periods, OXLC has been on a capital raising spree." End quote. At the end of 2020 and the beginning of 2021, as with most markets, we began to see the start of a new boom cycle in the CLO space. In the beginning, it was a modest pace, but like all boom cycles, momentum starts to heat up, as you can see in the owner's equity chart for OXLC and EIC, and again for XFLT. Now, let's take a step back for a moment as we recount the statement I made earlier about CLOs covering their distributions not poorly, not comparably, but satisfactorily. In this chart, I have overlaid OXLC NAV growth in brown, their capital raises, also known as paid-in capital, in green with their net investment income surplus/deficit or net investment income distribution coverage. This chart shows in greater detail what this chart here in the upper left is showing. If you look at the distribution coverage percentage before OXLC went on a capital raising spree in 2021, you can see that distribution coverage was comfortable at just over 30%, but as time passed and they raised more and more capital, having to pay yields in excess of 20% on those newly created shares took its toll on distribution coverage. You can see that as they continue to raise capital, represented by the green line going up, their distribution coverage diminished from comfortable to satisfactory to most recently poor. At the beginning of the new boom cycle, and distribution coverage was more than 30% plus, it's easy to understand why a fund manager would want to convert those excessive net investment income surpluses into greater investment opportunities by purchasing more CLO paper with newly raised capital. The problem is that they raised capital so aggressively that when they eventually hit a bump in the road, from say, I don't know, maybe an interest rate standoff between a president and a Fed chair as one possibility, there was no wiggle room. A distribution cut was the only logical thing to do. Fortunately, every asset class has a boom and bust cycle. Within each boom-bust cycle, there are often several corrections. Hopefully, this is just a correction in the current CLO boom cycle. Another warning sign that a distribution cut was in the cards for OXLC was that many of its peers had already made distribution cuts. EIC cut their distribution by 35% in July, and XFLT cut their distribution this year, 10% in February and another 9.1% in July. We have one more red flag to discuss, and then we can move on to where we stand and where we go from here. The final warning sign that a distribution cut was coming was when OXLC announced a 150 million share repurchase program. Again, from the March 28th article, I stated that if OXLC executed its share buyback program, it may reduce the number of outstanding shares, thereby reducing the strain on the distribution payout. That might remedy the distribution deficit. When OXLC announced a $150 million share repurchase program on March 20th of this year, this was immediately on the heels of just raising $494 million during their last reporting period ending September 24th, 2024. This 180 was very suspicious unless they recently discovered that all the new paper they purchased with that $494 million in the last period wasn't going to quite cover the yield it needed to satisfy all the new shares that were created. Anyway, as I mentioned earlier, because of the aggressive capital increases over the past couple of years, a net investment income shortfall was inevitable because nothing goes straight up forever, and it just so happens that now is the time for a pause or correction. It is fortunate that OXLC only cut their distribution by 11%. I, personally, was expecting a cut similar in size to the net investment income deficit of negative 32%. I also appreciate fund management's optimism that an 11% cut is all that is currently needed: share buyback, guidance, and technical analysis. While the share buyback program is still fresh in our minds, let's go ahead and start with that. To date, neither EIC nor XFLT have announced a share buyback program. Of the three CLO closed-end funds, OXLC was the most aggressive in terms of capital raises, net investment income deficits, and delay of distribution cut, so it is not surprising that OXLC is the fund most likely having to resort to a share buyback program. But there is a silver lining in this. You see, when OXLC was raising capital to buy more paper, they utilized what is called an ATM facility or at-the-market facility. An at-the-market facility is a procedure used by closed-end funds where they solicit the help of a third party to sell their shares on the open market. During that time, OXLC shares were trading at a premium, which means that minus commissions to the third party, OXLC received a premium every time they sold their shares on the open market. You probably didn't know about that, did you? That's because, despite closed-end funds being closed, they all have mechanisms in which to introduce new shares to market, and these new shares coming to market receive no attention because they are seldom, if ever, accompanied by a press release. Okay, that's a silver lining, a gold lining actually, but it's not the silver lining I was referring to a moment ago. Due to the severe market declines in share price, OXLC has lost its premium and now trades at a discount, which is bad if they want to raise new capital, but it's just what the doctor ordered in situations like this because now they can repurchase those shares they sold at a premium at a discount. When life deals you lemons, make lemonade, right? FYI, if you ever discover that a closed-end fund is purchasing their shares on the open market using an ATM facility at a premium, you better make certain they are generating the returns to justify it. Now, let's see if they've made any progress executing their share buyback program. On August 14th, 2025, OXLC issued a press release stating that they have already repurchased approximately 4.9 million shares of common stock at an average price of $3.53 per share, which represents 11.6% of the total 150 million share buyback program, but only 1.2% of their total shares outstanding. Upon completion of the share buyback program, if they utilize the entire thing, they will have reduced their total number of outstanding shares by roughly 8%. However, with retail investors already limping back in, there may only be a brief window of opportunity for them to execute it. Why might there only be a brief window of opportunity to execute? Well, for one reason, markets always have a tendency to overreact, whether it's to the upside or to the downside. 2, I've already mentioned that retail investors are starting to limp back and elevating the share price to 3.75 as of August 30th, which is 15.7% higher than their all-time low closing share price of $3.24 reached on August 7th. Third, on August 8th, OXLC issued a press release announcing unaudited net asset value ending July 31st at between $4.13, which is 1 cent higher than the $4.12 stated when they announced their distribution cut, to $4.23. Lastly, a footnote in OXLC's last investor presentation released on July 23rd for the period ending June 2025. A $383 million initial distribution to be received by OXLC by September 30th of 2025. This substantial distribution will be received due to a substantial investment made in the June ending quarter, but they were unable to credit it to the quarter. With fear subsiding in conjunction with the recent distribution cuts and evidence that the share buyback program is being used, it may have just disarmed the situation from getting much worse. Now, let's take a look at their chart to get an idea of what the market might do in the short term. We're going to begin our analysis using a 1-year daily chart for OXLC. As it stands for the close of trading on August 29th, 2025, market price is doing everything you would expect it to do from a charting standpoint. First, I'm going to draw your attention to an initial purchase that was made for the Divi-X high-yield portfolio of 300 shares at $4.15 a share on March 19th of this year. The pullback in market price around this time was due to the speculation regarding the unknown impact the upcoming Trump tariff announcements were going to have on the economy. This seemed like a good entry point at the time. There was a little back and forth over the next few weeks, but our position always remained in the green when accounting for distributions. On May 12th, our confidence in our OXLC position was reinforced when market price cleared a level of resistance and advanced to a new higher high. From that high, the share price pulled back to a higher low on May 28th. That higher low confirmed that the bull trend was still intact. Shortly after, share price formed a new lower high, which was a confirmation that the bull trend was over, because we did not form a new lower low. Instead, share price continued to dawdle along upward, forming a new trend. At this point, it was evident that OXLC was now trading within a triangle pattern. Whenever you have a stock trading in a triangle pattern, technically speaking, as the trading range constricts as it heads to the point of the triangle, it's time to get ready for the breakout. Now, the breakout upon confirmation can break to the upside or to the downside. Statistically, the breakout generally goes in the same direction as it did when it entered the triangle pattern. So, in the case for OXLC, when it headed into the triangle, it was statistically probable that the breakout was going to be to the downside, which it did. Before the breakout, it is possible, although it is not exact science, to get an idea of the size of the breakout before it happens. And the way you do that is measure the breadth of the triangle at its opening, and then when the breakout occurs, you tack that distance onto that point of the breakout. You can see in this chart, I placed a measured move at the time where I anticipated the breakout to occur, to the upside and to the downside, preparing for both scenarios. If we zoom in to get a closer look, you can see that our measured move gave us a price target of $3.59 a share, which it came close to on July 23rd, overshot it on July 24th, where it made a modest attempt at an intraday rally until it hit resistance at our price target of $3.59 a share. Our $3.59 price target also served as a level of resistance on August 13th and on August 22nd. Our first confirmation that the worst was not over would have been realized when we reached another lower high, in this case referred to as a dead cat bounce, on July 29th. We reached another lower low on August 7th when OXLC reached an all-time low of $3.18 a share, and then another lower high at, you guessed it, $3.59 a share. At this point, if you were to overlay a Fibonacci retracement tool that spanned the low price of $3.18 to our $3.59 price target, a 50% retracement would give us a price target around $3.40 a share. If we zoom into $3.40 a share, you can see an entire week of daily activity where share price just hovered around that 50% retracement level, forming a new higher low. Now, all we need at this point for confirmation of a trend reversal is the new higher high, which we achieved on August 25th. And as of the close of trading on August 29th, we're still in the higher high formation, waiting for the next pivot in price, which will hopefully form a new higher low before advancing back upward. In conclusion, in the short term, what we want to see is either a continuation of higher highs and higher lows, or a higher high into a consolidation period that will continue its upward trend on that breakout. The OXLC announcement of a 5-for-1 reverse stock split, you may be surprised to hear, aside from the administrative expense, is a whole lot of nothing. Unlike stocks of companies where their focus is primarily on growth, high-yield closed-end funds have no such ambition. Their primary goal is returning income. You see, if a growth company is forced to do a reverse stock split, it usually means the company is not only not growing, but it is contracting, and a reverse stock split is usually required to maintain its listing on the hosting stock exchange or risk losing access to public capital markets. If a high-yield closed-end fund is required to do a reverse stock split, it may have the same motivation for doing so as a growth company does, keeping access to capital markets, but not because it's losing money. As a matter of fact, very few closed-end funds lose money. Closed-end fund returns, for the most part, are generally positive. They might be lousy returns in some instances or negative returns at times, but they generally operate in the green. When a closed-end fund is forced to do a reverse stock split or merge into another fund, which is another popular mechanism for an NAV challenge fund, it's usually the result of an AV erosion which has taken place over a long period of time, usually years, which is the result of an overly aggressive distribution policy. And doing a reverse stock split just gives the fund a do-over to keep doing what they've been doing for years, paying out more in distributions than they make in earnings. It's that simple. This concludes the video. I hope you find it useful. If you would like to learn more about closed-end fund mastery or sign up to receive 1 free month of closed-end fund mastery reports, the link is in the description below. Thank you for watching. Please like and subscribe to this channel and/or my other channel for more coming closed-end fund videos.